Let me ask you something that might make you a little uncomfortable. What if everything you thought you knew about protecting your money was built on a lie? Not a small one. A massive, Wall Street-approved, textbook-certified lie that has quietly wiped out retirement savings, destroyed nest eggs, and left millions of people blindsided right when they needed their money the most. I know that sounds dramatic, but stay with me for the next few minutes, because what I'm about to show you is something most financial advisors will never say out loud. And by the end of this video, you'll never look at your portfolio the same way again. Welcome to Senior Pulse US. Let's get into it. Here's the problem. Most people, and I mean most, measure investment risk using one thing: volatility. How much does a stock go up and down? That's it. That's the whole formula. And on the surface, it sounds logical. If something swings wildly in price, it must be risky, right? Wrong. Volatility is not risk. Volatility is noise. Risk is something far deeper, far more personal, and far more dangerous if you get it wrong. Risk is the probability that you will permanently lose the money you cannot afford to lose. That's it. And the moment you understand that distinction, everything changes. So let's talk about the 7 ways smart investors actually measure and manage risk. The real kind, starting with the one mistake that trips up even experienced investors. The first way is understanding your personal risk capacity, not just your risk tolerance. These sound like the same thing. They are not. Risk tolerance is how you feel about losing money. Risk capacity is how much you can actually afford to lose without it damaging your life. A 35-year-old with 30 years until retirement can tolerate a 40% market drop because time is on their side. A 67-year-old drawing from savings every month cannot. Most people only ask themselves, am I comfortable with risk? They never ask, what happens to my life if this goes wrong? Ask the second question, always. The second way is concentration risk, and this one is silent, deadly silent. You think you're diversified. You own 10 stocks, maybe 15. But if 6 of them are tech companies, you're not diversified. You're concentrated. And when that sector gets hit, and every sector gets hit eventually, you go down with it, all at once. Real diversification means spreading across industries, geographies, asset classes, and time horizons, not just spreading across ticker symbols. Here at Senior Pulse US, we talk a lot about building portfolios that can actually survive a storm, not just look good on a spreadsheet. The third way is liquidity risk, and this one keeps me up at night on behalf of investors everywhere. Liquidity risk is the danger that when you need your money, you can't access it, or you can only access it at a terrible price. Real estate is a perfect example. Great long-term investment. But if the market drops and you need cash fast, you can't sell half a house. You're stuck. Same with certain bonds, private equity, or locked-in investment products. Always know which part of your portfolio you can access within 24 hours if your world falls apart, because sometimes the world does fall apart, and it never sends a warning email first. The fourth way is inflation risk. This is the sneakiest thief in the room. It doesn't make headlines. It doesn't cause a crash. It just quietly erodes the value of your money, year after year, like water slowly dissolving stone. If your savings are sitting in a low-yield account returning 1% while inflation runs at 3.5%, you're losing ground every single year while your balance looks perfectly fine on paper. The number goes up, but the purchasing power goes down. Safe money that can't beat inflation isn't safe at all. It's just a slow loss dressed up in a savings account. The fifth way is sequence of returns risk. And if you are retired or close to it, this might be the most important thing you hear all year. Here's how it works. If your portfolio drops 30% in the first 3 years of retirement while you're withdrawing money to live on, the math becomes almost impossible to recover from, even if the market eventually comes back strong. You've already sold shares at the bottom to cover expenses. those shares can't grow back for you. The sequence in which returns happen matters enormously. A 7% average annual return sounds safe and comfortable, but if those returns come in the wrong order, the average becomes almost meaningless. Smart investors plan specifically for this, holding cash reserves, using income laddering, keeping some money completely protected from market swings in the early retirement years. The sixth way is behavioral risk, and this one is about you, not the market. You. Studies consistently show that the average investor earns far less than the average fund they invest in. Why? Because they panic at the bottom and sell, because they get greedy at the top and buy, because emotion drives decisions that should be driven by logic and a plan. Behavioral risk is the risk that you will be your own worst enemy at the worst possible moment. The solution isn't to become emotionless. It's to build a system that removes you from the decision when emotions are running highest. Written rules, automatic rebalancing, a trusted advisor you check in with before making any big move. Systems beat emotions every time. The seventh way is counterparty risk, the risk that the other side of your deal doesn't hold up. The bank that holds your savings, the insurance company behind your annuity, the broker managing your trades. These entities are not invincible. They can fail. They have failed. Before 2008, most people never thought their bank could disappear overnight. Then some of them did. You don't need to be paranoid. You need to be aware. Spread accounts across institutions. Understand FDIC limits. Know what protections your investments actually have, not what you assume they have. So let's pull this together. The market will test you. It always does. And when it does, the investors who survive aren't the ones who predicted the crash. They're the ones who already had a plan that didn't depend on perfect prediction. They measured risk the right way, personally, practically, and honestly. They knew their capacity, their liquidity, their exposure, their behavior under pressure, and they built a portfolio that could handle reality, not just favorable conditions. Most people hand their financial future to numbers on a chart and call it planning. The smartest investors in the room treat risk like a living, breathing thing that needs to be understood. Not avoided, not ignored, but genuinely understood. And that's exactly what we're here to do at Senior Pulse US. Every video on this channel exists for one reason: to give you the clarity, the confidence, and the real information you need to make decisions that actually protect your future. Not the watered-down version, not the version that sounds good but means nothing. The real thing. If this video shifted something for you, even a little, hit that like button, because it helps more people find this content who genuinely need it. Subscribe to Senior Pulse US if you haven't already, and ring that bell so you don't miss what's coming next. And drop a comment below. I want to know, which of these 7 risks surprised you the most? Let's talk about it. This is Senior Pulse US. Stay sharp, stay protected, and I'll see you in the next one.